Let's create a budget. Let's get out of debt. Let's build wealth. Guys, welcome back to the channel. So we're going over looking at the family as a business, and the next metrics we will use is the balance sheet. The balance sheet basically balances your assets, your liabilities. Your assets as in what it is that you have of value, your income, cash on hand, things of that nature, and liabilities, basically what you owe. A way to kind of explain assets and liabilities in your, let's say, your family. So let's say you own a home. The house would be your asset and the mortgage on that house would be your liability. So if you have $300,000 house, you owe $250,000 on it, you would have an asset of $250,000 and a liability. Okay, so $250,000, you'll have a net worth of $25,000. The house would be your liability, and then your, well, that mortgage on that house, so the $250,000 that you owe would be your liability, and then the value of that house is your asset. So the structure of a balance sheet is pretty simple. I mean, you basically have two columns. You have your asset and liability, and then on each side of that, so on the left side, the assets is broken up into two different categories. Your fixed assets, which is basically your long-term assets, so like your mortgage or your house. Cars could be fixed assets, so anything that is an asset that's gonna basically take you longer than a year to pay off will be considered fixed assets. And current assets is basically quick cash, so like cash on hand or your bank account, cash in your bank account. So anything that's basically pretty quick to convert into cash or to get really easy would be considered a current asset. And in the liabilities is broken up basically into three sections: owner fund, long-term liability, and short-term liability. And owner's fund in business is basically the reserves, owner's equity, things of that nature. Long-term liabilities are liabilities that you owe on long-term, so like mortgage, car. And then short-term or short-term loans. You could probably put credit cards in that section. Your utilities, things like that would be short-term liabilities. Now, with a balance sheet, your main goal is to basically balance the left side and the right side. So you want to balance your assets and your liabilities. So for fixed assets, it will be long-term. Mortgages, if you have your primary mortgage, if you have secondary, if you have rental properties, those would be fixed assets. Vehicles, this could be all the vehicles in your family. If you have motorcycles, or I suppose you could even put a boat in this section. So those would be like a fixed asset. Equipment, if you have a business or starting a business, I don't know, let's say it's like printing out t-shirts and you have to buy some type of equipment or machine to do that with. That equipment, or it could even be musical instruments, anything that can be sold of value would be basically a fixed asset. Stocks, if you're not in it for capital gain, if you're building like a dividend portfolio or something like that, where you're holding stocks for that you don't really plan on selling in the near future, within a year or something like that, that could be considered as fixed assets also. Current assets would be income. If this was a business, it would be like the revenue they're producing. Understand that part of looking at our family business, our family like a business, is in some cases we're going to have to use creative imagination. But throughout this whole series, creative imagination is being used quite a bit, even if you're not really recognizing it. So income, you're basically, you are the, in a way, you're kind of the one being sold. right? I mean, your time that you're working is being sold to the company producing that work for them. So you're the revenue, you're the income. The asset, that's the current asset. Your bank, you can utilize your bank, your family bank, as current assets. Credit cards can be a current asset. You know, if you apply, you get a new credit card, that's income. That's income that's coming into. So that's an asset. Just like in the mortgage, where, you know, that house that was worth $300,000, $250,000, it was what you had left on the loan. That would be your liability, and the house would be your asset. So in this situation, you know, if you have a, say, a $5,000 credit card, you owe $2,500. The asset is the credit card, and what you owe on it would be the liability. On the liability side, you have owner's funds. This will be so your savings account. Basically, this is basically whatever's left over after the business basically shuts down. So, you know, owner's fund would be the equity built in to anything that you're paying off already. You know, if you have a car that's worth $5,000, you paid $4,000 of that off, you owe $1,000. You know, depending on the value of that car, whatever's the value of it is part of the owner's fund. That's your net worth. Now, dividends, you know, owner's funds, you know, is basically it. Once you have your cash flow and you go to buy the stocks or those dividend producing assets, any money left over is owner's funds. That could be part of what's known as reserves. Those reserves you would use the next month to either buy more assets, increase your budget, or whatever you want. They're your funds. Your bank, you'll notice that on the asset side, you saw your bank. A lot of things in here will be, it's the balance sheet. You're basically trying to make everything equal. You're trying to make your assets equal your liability. So there will be some double up. Your bank is an asset in far as you can draw from it and use it anytime you want, but it's also a liability because you have to pay it back. So you're taking that out in the form of a loan. You're paying it back to yourself, even though you're the owner and even though it's your money. You have to put it on both sides because you still have that liability to pay it back, even though you took it out. It's a constant check and balance system. Your long-term and short-term liabilities will basically be equal to your fixed assets and your current assets. So fixed assets would be long-term liability. You know, just like I said earlier, your asset is the mortgage. So mortgage would be, well, your asset is the house. So mortgage would be on the fixed asset side, but you also owe on that house. So the mortgage will also be on the long-term side or long-term liability. Same with the car. The car itself, the value in that car is your fixed asset. The long-term liability is still what you owe on that car. The loan is the long-term liability. And then current assets, you know, if you have a savings account, in order to balance it, it's like a double entry. In order to balance it, you have your savings as an asset, or your income as an asset, because your income is coming into the family as revenue, but then it's also, you know, that it's a liability as far as utilities, because it's as soon as it comes in, it has to go out to pay to run. That's that operating cost. So those will be listed as your short-term liabilities. So again, guys, remember, you don't have to catch all of this right now. When we're going through the working model of it and we actually list out the examples and place them in the categories, there'll be more of an explanation on how certain things will be on both sides of a balance sheet. It's all to make sure that it balances. It's all to keep you on track, and it's just a metrics to use to make sure that, you know, where your money is going. You know, when we are looking to invest in companies, right, we're looking at the way they do things and the way they manage their money. think of yourself as that company. And when you're going to lose leverage, so if you're looking for a line of credit, personal line of credit, HELOC, even credit cards, they're looking at your business, right? And the way that you manage this and the way that you save and increase your income is a reflection of your management style. It's a reflection on the way that you run your business. So, you know, we're going to dig deeper in this and we're going to get more into it. So, but that's kind of a generic, quick overview of a balance sheet and the way that it works. Guys, I hope you found value in this video. If you did, I appreciate a thumbs up, and I'll see you in the next one.